Greetings, comrades. For the benefit of anyone who comes across this video that's not in my Unit 2 2024 Strath class, just a bit of pretext in terms of what's going on here. This is the third part of a three-part folio of practical exercises. Part 1, students were required to record a bunch of inventory movements into an inventory card using FIFO. Part 2, they were then required to record those transactions in the 4 special journals plus the general journal. And here we are posting our journal information or our journal totals in the special journals and also the general journal to the general ledger. I'll put the links in for part 1 and part 2, so there's the necessary context for where we got all these numbers on the left in the journals, but I'm going to get into it now. Okay, so looking on the right here, we've got some opening balances that we need to record in the general journal, in the general ledger, I should say. So let's work our way from left to right. We've got an account payable to Yarra Organics for 600. So if we go down here, that's a liability account, and an opening balance for a liability will go on the credit side. Accounts receivable, Bunnings, is owed 500. That's an asset. Opening balances for assets are on the debit side, just as they appear on the balance sheet. Next row, we've got 2200 in the bank. Bank's an asset. Opening balance for assets go in the bank, and for all of these we just cross-reference this with bank. Then we got some capital. Capital is owner's equity. Owner's equity is on the credit side of the balance sheet, so that's where we'll plonk the balance. Although I did put in the wrong number there, 2250. Let's just update that. Okay. GST clearing is owed to the ATO, so that's a liability. So let's just scroll down and find our GST ledger. Here it is on the credit side because it's a liability. And what else do we have? Let's just scroll back up. We also had some inventory, $350 worth of inventory. Inventory is an asset. Opening balance for assets is on the debit side. Okay, that's step 1 of 3. The next step is we need to post our journal information. I'm going to start with the general journal because of the dates. Now, again, where do we get these transactions from? Check out the links that I'll put in the details a bit later. So this first transaction on the 3rd, we had some drawings of inventory. So it's got 2 effects. So let's go to our drawings account, and it's telling us in the general journal what to debit and credit. So therefore, we can simply go to drawings and post a debit entry, and we're going to cross-reference that with the other account affected, which is the one underneath, inventory. So go to your drawings ledger, debit entry to drawings, and then we need to reduce our inventory, and we're going to cross-reference that with the other account affected, which is drawings. Next one. The next one is a sales return. It's got a sale price effect and a cost price effect, and we almost treat this as 2 separate transactions in terms of the way we post this to the GL. So let's scroll down and find our sales return account, and what we're going to do here is we're going to do a debit entry as we've done in the general journal because it's negative revenue. And we cross-reference that with accounts receivable. Okay, so again, it tells you on the 3rd line here that it's account receivable, which is comprised of the sales return and the GST. So let's go back to that GST ledger. GST is being debited. So we need an entry there. That's going to be a debit entry as it is in the general journal. And we're going to cross-reference that also with accounts receivable. So we've got two debits there that are total 88. Back upstairs to the accounts receivable. And now we need a credit entry because the account receivable is being reduced due to that return. And so for our GL entry, we just go sales returns slash GST $88 because it's a combination of those two accounts that are causing that $88 reduction. Let's deal with the cost price effect, which is down here on the left. We've got $36, reducing our cost of sales and topping up our inventory. So if we go to our cost of sales account, we have a credit entry because it's like a sale in reverse. And we're going to cross-reference that with inventory. And when we get down to our inventory account, we're going to debit that because the inventory is coming back in. And again, it tells you here what to cross-reference, the other account affected by the debits and credits in your GJ. On the 11th, this is for a purchase return with a GST component. So let's look at our accounts payable account up the top. So therefore, this is a debit entry because it's reducing the liability because of the return. And it's part inventory, part GST. So therefore, we're doing a slash entry to signify that this 55 reduction is made up of 50 in inventory and 5 in GST. So let's go downstairs to our GST account, and we need an increase in our GST due to the purchase return of $5 because we can no longer claim that offset that we have for credit purchases since it's a return. And then we've also got a credit entry in our inventory account for the 50. So again, that we've got two credits there, 5 and 50 equal that one debit. On the 15th, we had some advertising of inventory because of a donation to an approved charity, a bit of PR. So expenses increasing equal a debit, and we're not going to cross-reference that with bank. We're not paying for it. We're just giving up inventory. So then we need to credit our inventory account and cross-reference that with advertising. Just remember, with cross-references, it's always got to be the title of one of these ledgers. Okay. Final one is we did a stock take and we had an inventory gain. So therefore we need to top up our inventory by $14, which I've done down here. I'll get to these other two a bit later. And we need to create an inventory gain account. Revenue going up is a credit, and we cross-reference that with inventory. So that's that for the GJ. Now we're up to the final bit, which is our special journals. Now, let's pretend that we've had multiple transactions and we're directed to post this at the end of July. So from now on, we're going to be working with dates from the 31st of July, the end of the month, which is when we post our journals. So it might be slightly confusing for these purchases and sales since we only had one transaction. But again, let's just pretend we've been directed to post on that day. So let's start with our cash receipts journal. We're just going to work with the totals here. So during the month, we've had $13.55 for our total cash receipts. That's come into the bank, and so therefore that's increasing the bank. And in terms of the cross references, we don't want to write accounts receivable slash cash sales slash GST. So we're just going to cross reference this with cash receipts, which is made up of, like I said, a combination of these other totals. $25 in discount expense. So let's go down to our discount ledger. Now, that discount has nothing to do with the bank, sort of. It actually is reducing the amount that we receive from our accounts receivable. So in terms of the cross-reference, we're going to cross-reference this with accounts receivable since it's reducing the amount they owe. It's an expense, so that's why we've done a debit entry. Accounts receivable, so that $500 is the amount that's being reduced because those accounts receivable owed us because of credit sales, and now they're reducing that debt. So if we go up to our accounts receivable account, this 500 is actually reducing the amount they owe. And when an asset is being reduced, we do a credit entry for the full 500. Now, in terms of the cross-reference, and if we look at this transaction on the 2nd, we actually only received 475. 25 was granted as a discount to Bunnings because they paid promptly. So in terms of our cross-reference, we need to acknowledge that by having a bank/discount expense entry on the credit side. All right, now we're up to cost of sales. So we keep tabs on our cost of sales so we can work out GP, gross profit, in our income statement. So therefore, if we go to our cost of sales, it's an expense that's being increased because cost of sales decreases assets and owners' equity. And so in terms of our cross-reference, we always cross-reference cost of sales with inventory. That's the other account affected because in this case, we're giving up inventory. So therefore, we need to go to the inventory account and we need to factor in that reduction. Okay. Except I've just discovered that I have a gremlin there. So let's just update that, 390. Okay. Cash sales. So this is our revenue that we've received. So when revenue goes up, it's a credit entry. So let's find our cash sales ledger. And this one we're just going to cross-reference with the bank. $80 in GST. So we've collected that GST and we owe that money to the ATO when we do our BAS statement. So because it's a liability going up, that's going to be a credit entry in the GST account. And that's also cross-referenced with bank because that's where the money's gone. That's it for our cash receipts journal. Let's move on to the payments journal and follow a similar process. So step 1 is we've got $562.50. So whether you want to worry about that 50 cents or not, I'll leave that to you. I'm going to stick it in. So that money that we've shelled out for all of these other items needs to be recorded in the bank. It's reducing our bank balance. We've paid money, and when an asset goes down, it's a credit entry. So again, rather than doing a whole bunch of slash entries, accounts payable slash inventory slash GST, our cross-reference is cash payments, and that just signifies that it's made up of all those other items. Discount revenue, similar to discount expense in terms of our approach. So therefore, it's discount revenue. We need to do a credit entry when revenue goes up. It's a credit. And we're going to cross-reference that with accounts payable because the discount revenue reduces the amount we actually pay to our suppliers. So in terms of our accounts payable, the 600 here that we've actually paid during the month, or settled I should say, that amount is made up of if we look at this transaction on the 1st, the 570 that we actually paid, plus $30 discount that we've received by being prompt. Both of those are reducing our amount owing to the supplier, and when a liability goes down, we do a debit entry. The debit entry needs to signify that two accounts have been affected here. The bank for the $570 and the discount for $30 means we've got a total $600 that is reducing the amount owing to the account payable. Now we bought some inventory for cash for $175, so the inventory has increased. More inventory bought for cash, and so that will need to go on the debit side of the ledger, because when an asset increases, it's a debit entry. We cross-reference with bank because that's how we funded the inventory. We had some GST attached to that. Now, when we pay for items and there's a GST component, that actually reduces our GST liability. And when we have a reduction in our liability, that is a debit entry. Our cross-reference is going to be bank, because that's, again, how we funded that GST. Okay, we've got 2 to go. Purchases journal. So again, the date I'm working with here is the 31st of July, pretending that that's when we were told to post. So we've got $500 that we've bought on credit. So that's going to increase our inventory. An increase in inventory, which is an asset, will be a debit entry. And we're going to cross-reference that with accounts payable, because that's how we funded the inventory acquisition. The GST, $50. Well, because we're charged GST, eventually we're going to have to pay that, and that's going to offset the GST that we owe. So that's reducing our GST liability. A reduction in the liability is another debit entry. Cross-reference with accounts payable, that's who it applies to. $550 total. That is an amount increasing our liability because we're going to have to pay that to our supplier at some point in the future. So that's going to increase our liability. An increase in the liability is a credit entry. So again, we need to do a slash entry here because part of that 550 or 500 is made up of inventory and the other 50 is GST clearing. So we need to cross-reference the 2 other accounts affected by that. Okay, another cost of sales here. This cost of sales is from the sales journal of credit sales. So let's go downstairs to our cost of sales account. And this is our second entry. We had one for cash sales and now we've got one for our credit sales. I've just put that in to help students understand where I got those numbers from, given they've got the same cross-reference. That's not necessarily necessary when you are doing your ledger recording. There's a credit effect on your inventory because the inventory is being decreased. It's an out in the inventory card, so that needs to be credited to, and again, I've got the wrong number in here, so let's just fix that up. 174, okay. Nearly there, crew. So now we've got some credit sales, $400. That's an increase in our revenue, so that's going to be a credit entry. And again, we're not going to cross-reference bank, we're going to cross-reference accounts receivable because they owe us for those credit sales. And they also owe us for the GST. We're going to collect that, and then that's going to create an extra liability to the ATO. So we're going to need a credit entry in our GST account for $40, cross-referencing with accounts receivable because that's who's going to pay us. And then the final one is we've got $440 owing from our accounts receivable. So therefore that is an asset, and when an asset goes up, because we are going to receive that $440 in the future, that's a debit entry. Again, because there's 2 components, we're going to need a slash entry signifying that part of that $440 is from sales, credit sales, and the other $40 is for GST.